Hello, welcome to the LP Financial Services Forex training class, Introduction to Forex Trading videos. In Lesson 2, we'll compare the Forex market versus other markets. The foreign exchange market is unique because of the large trading volumes, the extreme liquidity of the market, the large number and variety of traders in the market, the longer trading hours, 24 hours a day except on weekends, from 5 o'clock p.m. Eastern Time on Sunday until 4:30 p.m. Eastern Time on Friday. The variety of factors that affect foreign exchange rates, and the use of leverage to achieve higher profits. Because the foreign exchange market is an OTC or over-the-counter market where brokers and dealers negotiate directly with one another, there is no central exchange or clearinghouse. The biggest geographic trading center is in the UK, primarily London, but New York, Tokyo, Hong Kong, and Singapore are all important centers as well. Banks throughout the world participate. Currency trading happens continuously throughout the day. As the Asian trading session ends, the European session begins, followed by the North American session, and then back to the Asian session, excluding weekends. In the Forex market, you are trading currencies against each other, which is different from trading on the stock exchange. Here are some major differences. The first difference is in our trading hours. The Forex market is open 24 hours a day versus 6.5 hours, excluding pre- and post-market hours for the stock exchange. The types of trading instruments. The trading of two currencies make up an investment in the Forex market versus one company making the issue in the stock exchange. The liquidity of the market. The Forex market exceeds $4 trillion a day on average, multiple times more than the NYSE. The type of leverage offered. The Forex market offers from 50 to 1 to 400 to 1 leverage versus 4 to 1 leverage for equities accounts. And the types of commissions charged. Most Forex brokers offer no commissions, only making money through the bid and ask price, known as the spread. In equities, most, if not all, brokers charge commissions. A spot Forex transaction is a 2-day delivery transaction, except in the case of the Canadian dollar, which settles the next day, as opposed to the futures contracts, which are usually 3 months. This trade represents a direct exchange between two currencies, has the shortest time frame, and involves cash rather than a contract. The spot market has the largest share by volume in foreign exchange transactions among all instruments. Futures and Forex are similar in that they are both margined instruments. Futures contracts are quoted with the interest rates built in, while in the Forex market you actually get paid or charged interest on a daily basis. If you look at the futures rate against the Forex rate, the quotes are higher, as this is the interest built into the price. Futures contracts expire on a monthly basis. The trader has to roll over to the next month if they want to hold on. In Forex, the rollover is called a 2-day swap. This is done automatically and also when interest is calculated for a payment or receipt. When we look at a chart comparing the Forex market versus the stock market and the futures market, we see that in the Forex market, one generally focuses on the 10 main currency trading pairs. It's the largest and most liquid market in the world, and therefore there is minimum slippage and order errors. In the stock market, one must follow thousands of stocks. The liquidity is dependent on the stock's daily volume, and therefore there is more room for slippage and error. In the futures market, the contracts expire on a monthly basis. The liquidity is dependent on the futures daily volume, and therefore there is more room for slippage and error. The Forex market also has no daily trading limits or curves due to the large liquidity, and the investor has the ability to trade in scalable amounts based on their desire, as opposed to fixed contract sizes. This will conclude lesson number 2, the Forex market versus other markets. In our next video, we will move on to lesson number 3. The general terminology is related to the foreign exchange market.